Hi, thanks so much for joining in. You're watching the Mutual Fund Show on NDTV Profit. My name is Alex Matthew. The topic I've decided to discuss today is something that we have discussed at several times over the course of the last year and a half or so, but it's still important to talk about. When a lot of people think about diversification, one of the aspects that they look at is investing in international equity. And that option is available. Indian mutual funds provide that option in various schemes. But because of the restrictions that have been in place, that have been put in place by the Reserve Bank of India, first of all, and then the Securities and Exchange Board of India, a lot of these schemes have actually shut for subscription. Some allow SIPs or lump sums on a case-to-case basis, but a lot of them have actually shut fresh inflows. As a result of which, there is actually something that is taking place. If you look at the ETF traded value of a couple of ETFs, and I looked at the Motilal Oswal 100, NASDAQ 100 ETF. If you have a traded account, I would actually encourage you to go and check out the price. Similar story for the Mirai FANG ETF. The price of those ETFs traded on the stock exchanges is actually 17% odd, when I checked it last, higher than the net asset value of those schemes. Now, that is probably because the demand for those schemes on the ETF have far outshot the supply. Let's talk about why that is taking place and what the options are available, because clearly you shouldn't be going out and buying something that is 17% higher than the net asset value. Joining me today, I have Rohin Pagdiwala, who's the founder of Pagdiwala Investments, and Rushabh Desai, who is the founder of Rupee with Rushabh Investment Services. Thank you so much, gentlemen, for taking the time. Rohin, I'll come to you first. We've been talking about this, of course, for quite some time, but and I'm sure that you've seen the prices of these ETFs, some of these. I've named a couple, there are probably more. Why is it, can you explain why is it that the prices overshot the NAV in such a big way?
Yeah, good afternoon, Alex. Good afternoon, viewers. See, I think the root cause of this is what you already mentioned, is that the RBI has restricted inflows into international funds, and investors are not finding an avenue domestically to invest in international funds, US funds or China funds or what have we. As a result, the only avenue, or rather, there are avenues available. There are some funds which are still open for subscription, but to the general public, maybe they don't know that what they are finding as an avenue to invest are ETFs, which are listed. The reason that that we are seeing a price anomaly is because the ETFs are no longer issuing any further units. So normally when you buy an ETF, you will have units issued, and those units will be close to the price of close to the underlying NAV. Currently, we are not, because fund houses cannot issue new units. We're seeing demand outstrip supply, and therefore those who have these units currently with them, they are selling them at a higher price, which is where I think people who are buying them might be buying them at a much higher price than they should.
And good explanation. Rushabh, therefore, it seems obvious right now, as we're talking about it, the price is significantly higher than the net asset value, which essentially is the measure of the underlying value of what you're buying. So it makes absolutely no sense to buy something 17% higher than that price, but people are doing it anyway. You look at the volumes, they are quite significant for the Motilal Oswal NASDAQ 100 ETF. Why is that such a bad idea?
Hi, Alex. Good afternoon. Thanks so much for having me on the show. See, what is happening right now is that over the past 10 years, US markets have actually outperformed the Indian markets. Okay. And looking at the depreciating Indian rupee, there has been a lot of demand, for these foreign products, especially in the US markets, because what people have understood is that having one foot in the US economy is utmost important today. See, there are a few reasons why. One is that these companies are substantially giant companies, Alex, right? Having global presence like Apple, Microsoft, Alphabet, etc. Having super high earnings, and also with the depreciating Indian rupee, it gives an edge, over the underlying returns. So if my fund or if the earnings or if the price is generating, say, like probably 12, 13 or 14%, and if the dollar is appreciating over the long term, say like by another 3, 4%, you're actually getting somewhere like around 17, 18 or 19% returns. So, looking at the past returns and the substantial rally what the US markets have seen, there has been a lot of demand in the US economy, in the US offshore investments. So, mainly RBI has kept it on hold to protect the Indian rupee, and rightly so. But at the same time, I feel, that, if we want to really explore the true potential of returns, then I think it's high time that the RBI opens up the subscription so that the retail investors can actually take the benefit.
Point well, point well taken. I just want to drill into the original point that I was making before we get into the options available, Rishabh. And also, of course, it's ultimately the regulators that need to take that call on opening it up. But Rohin, just to drive home that point, why is it a bad idea to buy an ETF at what, 215 when the NAV is at what, 183 or thereabouts? And here I'm talking about the Motilal 100, Nasdaq 100.
It's very straightforward. You're buying at a higher price than you should. See, the underlying value of the fund is the NAV of the fund, right? Which is published by the fund house. So let's say the NAV is, for simplicity's sake, let's say the NAV is 100 rupees, and you're going out and buying the same product for 115 rupees or 117 rupees, then you're really paying a price which is not the fair price, right? So ideally, what you should do is wait for a little while, let the price correct, which it will eventually, because the ETF price on the exchange versus the NAV should sort of converge over time. And when that happens, you can go and buy that product. But otherwise, you're paying more than you should really.
Yeah, okay, fair point. All right, so let's talk about the rest of this now, because we've established that buying these ETFs is not a good idea. Let's talk about some of the options available right now, because before we get into the liberalized remittance scheme, which a lot of people are choosing now to invest in overseas equities, there are still a few that are still available. Rohan, I'll come to you first on this. What are the schemes that are currently available to invest in, and what are the restrictions that people should bear in mind?
See, the overall restrictions that are imposed by the RBI and SEBI are twofold, right? There's an overall $7 billion limit on mutual funds investing mutual funds investing overseas. That's an industry level limit. And there's a sub limit of about $1 billion for each AMC. So no AMC can exceed that sub limit. Today, because of these restrictions, most AMCs have discontinued subscriptions, but there are some that are accepting. Edelweiss, Axis, Sundaram are some of the names that I am aware of that are accepting investments. Edelweiss, for example, has a US equity offshore fund of fund. US tech equity fund of fund. Axis has a global innovation fund of fund, which invests in the underlying Schroders global innovation fund, and so on. So Franklin also has a fairly large US opportunities fund to which it feeds investments from India. So there are opportunities available in the mutual fund route, and I think those are way better options to consider at this point of time rather than buying into ETFs, simply because the ETFs are about 15-17% more expensive than they should be.
That's a fair point. Rishabh, I just want to get into how much of an exposure you should have to international equities. I know that you pointed out that it's important to hedge against the dollar because ultimately we are a depreciating currency. We are very close to all-time lows on the rupee right now, in fact, as we speak. But how much of your portfolio, your equity portfolio, should be denominated in dollar then?
Alex, say like anywhere between 10 to 25% should do the job. Right. But also one can take a little bit of a higher tactical allocation from time to time when the markets fall, probably investing, say like close to 40-45%, and then reducing the exposure when the markets, rally substantially, and, some can do profit booking, but around 10 to 25% should do the job, Alex.
So, and therefore, follow up to you, generally people say that you should invest in something like a gold ETF or invest a certain portion of your portfolio, overall portfolio, in gold, because ultimately even that is a hedge against a weakening currency. Global prices are denominated in dollar, and the Indian price is basically derived from the global price. So, would you say that 25% includes gold, or is it outside of gold?
No, no, no. 25% is purely US exposure, Alex, because what happens is, see, gold is not volatile, but it's going to be super cyclical. See, when the dollar, see, gold globally is traded mostly in dollars, right? So when there is high demand for dollar, it's basically like an inverse relationship. Gold and dollar plays an inverse relationship, Alex, right? So don't mix currency and commodities together. If you're investing in gold, then keep that asset class or that portfolio absolutely very separate. And if you're investing in an asset class like equities, whether it is Indian equities or US equities, keep that very separate, Alex.
Rohan, your opinion on this? 25% is what Rushabh says. Is that aggressive? What is your thinking about how much you should have exposure? And I'm asking in the context of what? NASDAQ 100 or NASDAQ Composite actually overnight hitting all-time highs.
Yeah, so I wouldn't go as high as what Rushabh mentioned, but I think the larger point is that there is some exposure that you should have in dollar-denominated equities. In my view, 5 to 10% is a good amount of exposure to have. And of course, there are tactical opportunities. So when valuations in the US are attractive, that can be increased over time. But I think 5 to 10% is enough, especially because we are in a country which is growing at a compounded annualized. I mean, the returns from our equity funds have been about 14-15% compounded for a while now. So I wouldn't expect.
Just a quick clarification, gentlemen, you're talking about the a percentage that you're talking about as a percentage of equity or a percentage of overall portfolio?
Percentage of overall portfolio.
Okay. Thanks for that clarification. So if you've established that you have to do about 10%, 5 to 10% in your opinion, a little higher according to Rishabh, what are the options available? Because as we've established, most of those options are not available right now. So should you at all consider the LRS route, the liberalized remittance scheme route, which essentially you would have to create a brokerage account that allows you to invest in international assets, equity, ETFs also obviously, to the extent of $250,000 per year, which is quite a sizable amount. Rohin, to you first.
See, for a retail investor, my recommendation would be to not go the LRS route unless you have, of course, large tickets that you want to do. Simply because the LRS route is fraught with a lot of complications. There are complications in the account opening process. You need a broker in the US or whichever market, or you need a broker in India which has a branch or a tie-up with an international broker. So there's a lot of processing and paperwork involved. Then it's fraught with charges. So there is charges for remittance, there's exchange rate charges, there are account opening charges, and so on. So even with discount broking now becoming commonplace, I think that the charges are still significant, and it might be just easier, simpler to just do it through an India-oriented US fund or a global fund. And while most funds are shut, there are still enough funds available where you can invest.
Fair point.
So an example is the Franklin US Opportunities Fund, Axis Global Innovation Fund of Funds. So there are options.
And there's a whole list, and they keep opening up because the rule currently states that as and when they have redemptions, they can actually open up to the extent that they need to. So I think we've covered this to the extent that we need to. I really wanted to draw attention to the fact that ETFs are trading at a significant premium, and to be aware of that and not make the mistake of going and investing in that, because there's a huge gap. 17% is nothing to scoff at. Let's jump to some of the questions that we've got, gentlemen, because the first one that I've got from Bhavish, who is 34 years old, is actually related to international investment as well. He's saying that he's looking to invest or maximize the China opportunity since the valuations are down. Of course, they have recovered quite considerably from that low point. But which funds can he invest in that can give him that exposure? Rushabh, do you want to weigh in here?
Alex, I wouldn't suggest him to go into the China market right now. The reason is there are a lot of uncertainties both at the political level and at the geopolitical level as well. So I think holding horses for some time just to understand, how, because Because see, China is not a very transparent economy also. So the data what they put out, it's we can't really take it on face value. So waiting for some more time. See, although the valuations are very cheap, there is a good upside opportunity in the China market, but holding horses and waiting for some more time to see some stability in the China market is something what I would recommend.
Rohan, you want to quickly weigh in on that? A lot of people are looking at that opportunity. Global funds seemingly have moved towards China. Of course, they may have been questioning that decision over the last couple of months.
Yeah, I tend to agree with Rishabh's point of view here that the Bhavish might be better off waiting it out rather than entering China. But if he must, then there are two funds that I can think of, which is the Edelweiss Greater China Fund, the Axis Greater China Fund.
Coming back to you then on the next one, Mohammed has got the goal. He's 23 years old. He's got the goal of building a 5 crore corpus over a 30-year period. And frankly, I don't think that he's thinking big enough. Do you agree? Rohan, you tell me. 20,000 is what he's starting with on 4 funds. The reason I'm saying that he's not thinking big enough is because he's 23 years old. And he's doing what I think a lot of us, me certainly, didn't do at that age, which is to start investing 20,000 rupees a month. He's got MOSL Mid Cap, Franklin Small Cap, Navi Nifty 50 Index Fund, and the UTI Innovation Fund. Is he on the right track?
If the goal is 5 crores in 30 years, which is, I think, a very small goal, which sounds big now, but he's got to account for inflation over 30 long years, and that's so the number is very small. But if that is his goal, then 20,000 a month should be enough, assuming equity will give 12% annualized returns. The composition of the fund itself, I think MOSL Midcap is fine. And Navi Nifty 50, there's nothing to really say. It's an index fund, but I would maybe consider replacing the UTI Innovation Fund with a multi-cap option. Either a Nippon multi-cap or a Mahindra multi-cap might be good replacements. And from a small cap perspective, Franklin small cap, I would replace with maybe a Bandhan small cap.
Fantastic. Do remember, Mohammed, that you should be incrementing your investments every year. That, more than anything else, is going to drive you to your target and beyond that. So if you can, 10% is a great increment every year. In the earlier years, of course, as your income goes up more than 10%, obviously, hopefully, it's going up by 20+%, and you can therefore increment it by 20% in the first few years, and that makes all the difference. Trust me. Joanne has got the next question. She's talking about whether or not any specific IT fund can be invested in that is closely involved in the generative AI sector in India. Perhaps a little early for that. I'm not sure about what Rishabh has to say. Rishabh, I guess tech fund, a lot of people looking at a tactical allocation into a thematic fund. Anything that you can suggest?
On the tech side, especially what Joanne is looking close to, the Gen AI in India is still very premature. I think Edelweiss has a beautiful product called Edelweiss Technology Fund, which invests around 70% in Indian technology and 30% in the US technology space. I think that product will cover the AI, because AI is more matured in the US economy rather than India. So taking an exposure through a mix of both Indian technology space and the US technology space makes sense. But one should keep in mind very carefully that the investment should be tactical and should not be in their core portfolio, Alex.
Okay. All right. The next one's an interesting one. And unfortunately, we don't have all of the details. Rohan, with that caveat, Balbinder, who is 60 years old and has 2 crore of a lump sum investment that he wants to make, and he says that he wants to have an aggressive portfolio over a period of 5 years. I hope that he has a considerable amount of money that is set aside as his nest egg, and this 2 crore amount is a relatively smaller portion which he wants to put into equity. With that caveat, what would you suggest that he build?
I'd suggest a mix of combination of funds, actually, multi-cap, mid-cap, small cap, as well as maybe an index fund. But I think the points that you made are probably more important here, is that he, because he's at that age of 60, he should first have something which is, let's say a safety net or a nest egg, like you mentioned. That's the first thing that he has to account for. If this 2 crore is to be invested in aggressive options, which he's mentioned, then I would think a Motilal Oswal mid cap, Mahindra multi cap, Bandhan small cap, and maybe a DSP equal weight Nifty 50 index fund might be a good mix for him.
I just want to drive home that point a little bit more because I'm assuming at 60, Balbinder is just retired. He's probably got a corpus. Hopefully, he's gotten his EPFO amount and is not struggling as some other people are. And he's gotten that amount and he's looking to invest that. Rishabh, do you want to weigh in on how much of his portfolio should be equity and how to construct his aggressive portfolio?
My view is slightly different, Alex, because he has a very less time horizon of 5 years. And plus, looking at to his age, I wouldn't venture into mid caps, small caps, or multi caps right now. I would park this money probably say like in dynamic asset allocation funds, which is a mix of both equity and debt. So out of the 2 crores, what I would do is around 1 crore or 1 crore 50 lakhs should go into dynamic asset allocation funds, and around 50 lakhs or so can be parked into pure debt mutual funds from a capital preservation point of view. I wouldn't take too much of risk for the period of 5 years, Alex.
Yeah, okay, that's fair. So your point of view is that if you are to extend the time horizon, which I think he should do, Balbinder, there's no reason why you should be thinking about just the next 5 years. You should be thinking about the next 2 decades, in fact. And from that perspective, perhaps it's a better idea to take that kind of an allocation. Of course, what Rohin has pointed out is assuming what we said at the start, is that you have your allocation. Yeah, you have your allocation towards fixed income and towards the other asset classes already taken care of. Mahinder has got the next question. Is it a good time to invest in gold or silver ETFs? He's looking to diversify his portfolio. Rohin, we kind of not addressed it, but we kind of alluded to this earlier on. I didn't give you the opportunity to speak about it. What do you think about gold and silver?
See, gold particularly, I think is a useful aspect of a portfolio when you want to hedge against financial crisis or global crisis of any sort, right? So gold typically will do well during times of war, times of any kind of financial shocks, etc. So I think about maybe 5 to 10% of the portfolio can be in gold. Having said that, I don't think the returns that people should expect in the year or two going forward will be the same that they've seen in the last 3-4 years. So I don't expect stellar returns from gold, moderate returns at best, and not more than 5-10% of the portfolio. Silver, I don't have a view on, but assuming that silver closely follows gold, in most cases, it's definitely more volatile. But I would expect again maybe high single-digit returns from gold, silver in the next year or so.
Yeah, I'm doing a quick search because I can't remember the exact value, but I would encourage all my viewers that are interested in silver to check this out. Do a search on how much of silver is driven towards industrial usage. And you will actually notice that when there is a boost or when there is a spurt in industrial activity, you will generally see silver prices going up along with other base metals as well. Because a considerable portion of silver demand is actually driven by industrial demand. But I just want to very quickly throw it to you, Rishabh, and then we'll close out. You've already made your point on gold, but how much of your portfolio is to gold, maybe even silver?
5% to gold is fine. I wouldn't put a lot of money on silver because silver is very closely correlated to equities and it is as volatile as equities. So if someone wants to take exposure in silver, then might as well invest in the equity markets. This is what I would suggest. But around say 5% to gold in terms of in mutual funds and another say some percentage into, because it's very important to have physical gold as well. So a combination of physical gold and holding gold in the digital format should do the job.
Okay, all right. Thanks so much for that view, Rohin and Rishabh. Thanks so much for joining me on the show, in fact, and for answering all the questions that you did. It's been an absolute pleasure having you. All right, and that brings us to the end of this particular edition of the Mutual Fund Show. It's been a pleasure. Thanks so much for tuning in. This is NDTV Profit.